There is great income disparity in the United States, unlike anything that we've probably seen in 40 to 60 years. That's driving the skewing of the income burden to the upper earners. Corporations and pass-throughs. The last time we did a major corporate reform bill was in 1986, and back then about 71% of all business income was reported on a C corporate return. As I said today, it's about 50% according to the Joint Committee. Our numbers show that it is actually probably close to 48% is now reported on a corporate return. So if you slow down a depreciation deduction to help offset the cost of lowering the corporate rate, pass-throughs get nothing out of that. Pass-throughs get nothing out of that, and they will not stand. They will not tolerate being used as a revenue raiser to pay for corporate rate reform. And it's causing great problems in the House of Representatives. They've had to have now yet another hearing on the effect of tax reforms on pass-throughs, which is scheduled for next week. But an interesting figure, of that 50% of business income that's reported on pass-through returns, about 55% of that 50% is reported by 2.7% of the largest pass-throughs in the country. That's probably private equity, and I'm hoping it's not large accounting firms, because there's a movement afoot to treat large pass-through entities as corporations for tax purposes. Mr. Bowles' commission, who you'll hear tomorrow, has actually proposed that as well. To equalize the treatment, what Secretary Geithner said, entities should not have their choice of paying corporate taxes according to how they choose to form their entity. Publicly traded partnerships, master limited partnerships are clearly under the firing line on that. And then when you look at our corporate rate, we're way out of step with the rest of the world. We are currently the highest statutory corporate rate in the world, fully loaded state and local, 39.1%. The OECD average is 24%, probably going down to 24% next year. And the UK just announced that it is reducing its corporate rate to 20% after having adopted a territorial tax system. What's the territorial tax system? We use what's called a worldwide tax system, meaning that every dollar of a US-based corporation, regardless of where it's earned, eventually will be taxed by the United States government. And for your foreign earnings, as you probably know, they're not taxed until you actually bring the earnings back. Bringing them back, I would note, to tax them at the highest corporate rate in the world. Now, you get a credit for whatever taxes you paid overseas, but if the overseas average is 24%, you're going to pay 10%, or 25%, you're going to pay 10% top-off tax when you bring it back to the United States to get up to 35%. And it has produced what most economists refer to as the lockout effect. And you've read about it recently with Microsoft and Apple and other companies finding it's actually cheaper to borrow money in the United States to pay their dividends than it is to bring their foreign earnings back and lose on average 39.1% of it.